day at the chart, a sea of red, talking puts and calls, but they just stare ahead. Strike price means nothing in the black minds, margins and leverage like mountains to climb. Spent the whole week on Delta and
Where you go up and down here. You see how your mouse turns into something different when you, oh, there you go. Thank you. All right. So that gives you an idea of what the market's doing. The ability to look all the way across all these different tickers in the market. Drag this out a little bit too. You don't need all that room. Drag right here out some towards this way. There you go. There. Well, that's a little much, but whatever. Now look at your Russell. Open up your Russell. The futures product, the Russell, that we made an adjustment in. And now we have a problem in a different direction here. Now you see what we're running into. The market's rallying so much. It's up 59 points today. That now our call is worth $23 and our put is only worth $8. So we're going to address that. There's two ways that we could address that. We could simply roll the put up. Your put is which put? The 2350. So look and see what we can get. Go to trade and then type in /RTY and trade. Look and see what we can get if we roll that up 50 points. RTY. That might be all we need to do. So if we take it from 2350 up to 2400, what does that give us? The put side, right side, put side. You can see the little red. You see where you see where you are currently. You'd have to buy that back, hold down control, and hit the ask. If we're buying something, we're hitting the ask, and then the 2400. That gives us about 17. I think we had 23. Yeah, that's probably a good option for now. We're going to check one other thing. Go out 7 days. So before you put this through, close this option chain, minimize it, and then go out 7 more days. So 18 days till expiration. And currently, your current option has a value of around 9 or about 10 or so, it looks like. So what is it, the 2350 a week out from now? The same thing as what we're going to be. Let's do that instead. So instead of going up to the 2400, all right. What is the 2400? 27. I don't like getting that close. So just roll it out to... first things first. Just put that order through. The one that we already have. The one that's sitting there. Go ahead and see if you can put that through here. Go ahead and hit send. Didn't get filled. Shouldn't have to adjust it much. Ticket for selling stuff. There you go. Try that. There you go. Now you're filled. Now go back to monitor and see what your overall delta is now. So overall, do you see your delta? Is your delta not on there? Why is your delta not? You have to add your delta separately on the futures portion. So what your overall delta now is -5. Your beta weighted delta. I'm not beta weighted. Why is your overall delta showing something different than mine? What the heck? Does your overall delta say 20 something? Negative 20 something?
Yeah, -26.
Take off your beta weighting. Okay.
-6.
Yeah, -6. So that's the equivalent of... So with beta weighting, put the beta weighting back on. That's why I was doing that. So with your beta weighting, it was changing that to basically the SPY. So -25 SPY. And then what's your overall delta for your equity positions up above? Beta weighted.
24.
24. So basically you're flat here. You're totally flat. You've got premium working on both sides of the market, and then you've got a bunch of positions that are directional. How much are you up today? Daily P&L, you're up about $1,000 today. So getting that back in line was one of the biggest things I wanted to do. And then it's probably time to look at something like AMD that's now up 190 bucks. Do we want to leave that on? Ideally, I was hoping for about 250 out of that position. So maybe we leave that on for a little bit longer. What's that marking at? 116. So it's fallen a little bit. It was higher earlier. One thing that had a huge move today that now you're going to be short in is that AG, because silver rallied like crazy. So when you open up AG, you'll notice one thing. What's the first thing you notice when you look at the prices of your two options in AG?
Like the same?
What are you looking at?
The trade price? What are you talking
No,
about?
not the trade price. The mark price. Mark means what it's marking at right now.
Oh,
That's that current price. So what do you notice when you're looking at those two options at the mark price?
there's a big difference.
Yes. So that means this stock has moved one direction. One side is getting tested, the other side is winning. So originally when we put this on, we put them both on for around 27 cents and 29 cents, around the same price. Over half of the value of your one contract is gone. So how would we get some more value in that contract?
By putting it closer?
Buying it back and selling something closer. Yes. Or you can roll it out further in time. But for this particular example, we're just going to roll it closer to the strike price. So go ahead and open her up. Open up your... Why is... Oh. I was trying to trade the same thing. Let me look at my computer screen. So if you're buying back the put, are you still having trouble knowing which side to go on? The puts are on the right, the calls are on the left.
Yeah.
Buying back the put, how do we do that? We click on what? Bid or the ask.
I can do that.
All right. And then now we want to bring our delta, or we want to bring our delta and our credit back so we have something working towards us if this thing continues to rally. So what would you choose? How far up would you roll this?
Probably like 12.5 or 13.
Yeah, I would choose 13. That would be my... Oh, shoot. Never mind. I did a boo-boo.
Yeah.
I messed up. I held down shift on my screen. All right, so now all you need to do... delete that order because I accidentally just put an order in and it got filled. Wait, go back.
Oh.
You still have to... I only did one side of the transaction, so I sold the 13. So now you need to go back and buy the 11 and a half. No. Make sure it's at the mid price.
What?
The 11 and a half, put it in at the mid price.
Like that?
Yeah, take it down to like... There, try that. See if you can fill that 13 cents. Perfect. You got better than the mid price, so that saved us some money. All right. So now when you look at it, now look at your new position. You went from being basically 22 delta in there short. Now you're only short 4 delta. So you've kind of got your deltas back in line. And you have premium on both sides that can work in your favor. What else do we got? Archer. This one's marking at 1270. So you notice that I bought did we talk about the fact that I bought some shares in Archer because this thing started to rally? So I bought a little bit of protection for you. Yes. I did the same thing in Applied Digital. You notice I bought these shares? I don't think we talked about this. So this thing it had earnings. I didn't realize earnings were literally like the day after we put this on, and it rallied like $6 or some dollars in one day. So what I did is overnight I bought some shares just in case it continued to rally. And this will cut these 50 shares will basically neutralize this call by 50%. So before, when the stock goes above this $43 price, you lose $1 for every dollar above that price it goes, right? So $100 for every dollar it rallies above that. But when you buy 50 shares, it basically cancels out half of that. Because remember, the options control 100 shares. So now that if we're getting tested to the long side, this is a static delta hedge, basically. So we're hedging ourselves to give us a little bit of more upside room for this thing to continue to rally, and we still get to collect the premium, and it just gives us a higher profit, not higher profit potential, but a higher break-even point to the upside by adding a few shares. What else do we have open? You've got Bull open. How's that position doing? It's actually profitable so far. We'll leave that one alone. Which ones are your worst positions? Really, it's that applied because of that massive move on earnings. Then you've got this PAL is working out really well for you. The PALL, Palladium. That call is worth what? $2.32 or so. That call only has 4 days left till expiration. So that $2.32 of extrinsic value will be gone by Friday, one way or the other. Either we'll rally through it or we won't, and this contract will have zero extrinsic value by Friday. So then we'll have to decide on Friday what we want to do with this call, whether or not we want to let our shares be called away, or if it's worthless, let it expire and sell another one into the future. And then what else? Reddit, Snap. Remember, we did a cover call on Snap. So this one should be a loser because the stock has fallen about 50 some cents from where we put it on. If the stock fell 50 cents and we had 100 shares, we should lose how much value? About $50, right? But if you look at your overall profit year to date, you'll see that that's not the case. Why is that? Why is that? Why didn't you lose the full 50? Because you bought the stock at $8.49. It's now $7.98, which is over $50 in loss. So why didn't you lose the full 50? You only lost $31 so far. Why?
Is it because we bought 100 shares?
Yeah. If you buy 100 shares and the price goes down by 50 cents, you lost $50, right?
Yeah.
Yeah. So why is your P&L not showing down 50? There's another derivative there on that option chain, right? So it's not just Snap. It's not just 100 shares of Snap. What's the other derivative? What's the other option there?
Oh.
A call. Is it long or is it short? Are you short it or are you long it? No, if you're long something, that means you own it. The quantity. Look at the quantity. Is there a plus or a negative in front of it?
You're selling?
You sold it. You're short it.
Oh.
If you sold something, you're short it.
Every buying something is long.
Yes.
Okay.
So if there's a negative in front, you see how the shares have a plus in front of them? You bought them.
Yeah.
And then we sold the 10 call against it. So that 10 call had a value of what at the time that we sold it?
10.
What?
What?
What was the trade price for the 10 call?
0.65?
65 cents. So it had a value of 65 cents at the time that we sold it. What's the value of it now? What's it marking at now? Go to the mark.
0.45?
0.45.
Yeah.
That tells you why you're not down 50, because you sold something for 65 cents. Now it's worth 44 cents or 45 cents. That's the other $20. You made $20 off the call as the stock went down $50. So that's why you're only down $30, because those two positions are countering one another to a degree. Then Reddit, I don't think we'll touch that. That still has. So this Reddit position you sold, or I think I did that one before we even started. Sold it for $2. It's worth $1.50. We'll wait and close that one out when it's down to $1. Then we'll close it out. The closest one to being closed out is your AMD, honestly, but you still have maybe 50 cents or so left in there that you probably can squeeze out of that. So now we need to go back to our scanner that we built, run the scanner, see what is in the market that's interesting today. Again, we're going to have the same names that we've been looking at, but we might have a few other names in there that are getting interesting because we have earnings coming up too. So that's going to have to be something. You see all these different symbols in front of the stock name?
Yeah.
If you click on them, and it gives you a description of what it is. So you see the blue one there? Yeah, it means earnings is coming up. So keep that in mind. We want to try to avoid selling
1%.
premium into earnings wherever possible.
Uh,
So Amazon looking interesting here, but Amazon, I'm going to click on that, and then I'm going to see the earnings are at 10:30. So basically, in less than 20 days, we're going to have earnings on Amazon. The implied or the IV percentile is 46 for that one. Let's try and find one that we can potentially trade. What about a firm? They also have earnings. It's coming up 11.6. You know, I was looking. Let's see if it's on the list. Is MP on this list? I don't see it. These are all alphabetical. Why are they alphabetical?
Oh, A.
Yeah, why are they alphabetical? I don't want them to be alphabetical. I want them to be sorted by volume. All right, hang on. Go to your show where it says show. Show up top
Where does it say that?
where it says
Oh.
50. Show fit. No. Down. Over. To right. Look at my mouse where it says show. How many we're gonna show? Look at my mouse.
I'm looking at it.
Mine don't say that.
It doesn't
Oh,
say
yeah,
show
that's-
right there. All right, so go ahead and put that to 2,000. Then rescan. It says you request a very large number of symbols. It may consume a lot of memory and traffic, degrade performance. Just say yes. See how long this takes to load. Not that long. All right, so now we're getting a list of 2,000 stocks, and we're sorting them by volume. This is a much better list. We should have done that from the beginning. All right. So is MP on this list anywhere? It should be relatively high on this list because it had a massive move today. I don't see it. Either way, though. This list is a better list for us to work with. Let's go to trade, and I want to look at MP. See if there's an option to put on something in MP here because this stock is definitely in play. Go to the expiration with, well, first of all, let's look and see when MP has earnings. Let's go to chart, MP. Is this going to tell us when earnings are? It's not. How do we find out if it's going to have earnings? Go to our scanner. If it were in our scanner, that would tell us. When are earnings for MP? Well, just based off of the volatility, we should be able to tell when the earnings are. Looks like they're coming up soon. Looks like they're this coming week. Honestly, looks like they're either this week or next week. All right, so let's go out to November, the 39-day. Go back to your trade, MB. Go to the 39-day, and then let's see what we can get in here for. Holy crap! There's not enough strikes. All right, go back. We're not doing the 39-day. Go back to the 11-day. This is more like it. All right, so let's look at selling the 125 in the 11-day. Go ahead and click on the 125 to sell the call. Hold the control down. And then let's go over to something like the 80, or no, the 85. No, you did the bid. Or you did the ask, not the bid.
Cool.
You see how it says plus down there? Yeah, that's what you want. So this is going to give us $5. Go ahead and hit confirm and send, and let's see how much capital this is going to require. $1,200. So yeah, I like this. Even though we're going through earnings, more than likely, the risk reward in here, this giving us how much to the upside? Basically $25 the upside, and about $10, $12 the downside, and it's leaning us a little bullish in this, so it's going to give us long delta. Go ahead and hit send. See if we get filled on it. All right, instantly filled. So that's a really juicy one. The implied volatility percentile in there is probably high if I had to guess. Why is it not showing me that information? It's somewhere in here. Today's option statistics. Go back to the trade. Go back to trade. Then go to, you see the down, lower, below the option chain where it says today's option statistics. It's going to tell you where this is where you can find the implied volatility percentile, current IV percentile, 100%. You see that? On the left-hand side, you see that it says
Yeah.
yeah. So that means 100% means it's at the highest point that it's been in the last year. So there's good premium to be sold in here. There's stuff going on in here. So that's why we put that trade on. And you can tell it's at all-time highs. This is a materials company right now with metals going crazy and different commodities going crazy. That's why this thing is going nuts. That with the fact that the government has basically backed it. So, what else? What else? What else? Do we want to do one more trade? Let's go to our scanner now that we have 2,000 stocks to look through. You didn't rescan, did you? Or you did? You did. Plug Power, that's too low of a stock price. Nvidia has huge volume, but not a lot of IV percentile. Can we, if you sort it just by IV percentile instead of by volume? Do you not have IV percentile on there? You have to add it to your list. If you, no, yeah, yep. IV under, no, the little, you need the little underscore or the under. There you go. There you go. You have to hit add. You gotta hit add. No. Oh, okay. Gotcha. Then hit OK. All right. So now you've got on there. Sort it by that. Now you're looking at them. The top every stock on your page right now is close to 100%. So any of these are going to be really, really good options. However, you've got a lot of these characters in here with only like a million in volume. So you look at and focus on the ones that have 20 to 50 million in volume, and then we'll go through them. So the first one of those is going to be BE. The next is going to be this KDP. The next is going to be RXRX. That's a pharma company. We're not trading that. Keurig, Dr. Pepper. All right, let's look at the KDP, the Keurig Dr. Pepper. Let's see when the earnings are, 10/27 before market. Okay, let's put on a trade. Let's look at putting on a trade in Keurig. So KDP. And let's look at doing something KDP where we sell before earnings and we buy after earnings. Oh, this thing's gotten wrecked. Wow. Okay. There's not enough liquidity in here for us to trade this, honestly. Yeah, I don't like that. So let's go find a different one. CIFR, Cipher, Ming Inc. Never traded it. It's up 20% today. Don't like that. RR. This is a robotics company that Josh has traded, but I don't like that either. It's too low of a price. RKT, which is Rocket, which is a mortgage company. Don't like that. QS, QuantumScape. All right, let's see if we can find something in QuantumScape. Let's see when earnings are. 10/22 after the market. Okay, so let's go to QS. Liquid, or we have weekly options, which is good. 10/22 is going to happen on the week of October 24th. So we're going to open that one, and then we're going to open this week. This week too. Open this week. All right. So let's look at the chart and see what QS looks like on the chart. Link your chart to, so go back to trade. And then you have a red thing for your trade. So go back to your chart now. That's fine. Go back to your chart and make that red too. There you go. All right. So basically this thing's rallying to new highs. And this is, how long of a chart is this that we're looking at? The daily chart. Okay. We're trying to find new highs. It's going to have earnings. So let's do this. Go back to your trade. Give me 1 second. Let me get my chart to look like what your chart was. Jeez. So let's look around the $12 price range and the $20 price range if possible. I don't think we're going to get anything for the 12. So you might have to go to like the 15. So, all right, let me go to trade. For this weekly, we're going to sell the weekly. And then for, oh dear. Do we want to do both sides or do we want to pick one side? Do you want to continue to have a bullish outlook or do you just want to try and capitalize on premium?
We do one side.
Which side? You have to pick whether you're bullish or bearish if we just do one side. Let's do both. So let's go to, all right. It's currently trading around 17. So we're going to buy both in the 11-day cycle. We're going to buy the 17 put and call. Hold down your control. Do the put and the
11?
call. What's that?
In the 11?
In the 11-day cycle. We're going to get long the premium in the 11-day cycle. You're on the 4-day cycle right now. No, in the 11-day expiration, not the 11 strike.
Wow. How do you cancel this?
You don't have anything in.
Oh, why is it? Oh, these.
Scroll down to the 11-day. Then click on the bid. Hold down control. Click on the bid for the 17 call and the 17 put. The bid. I'm sorry, the ask. My bad. And then the ask again. Yep. All right, so $3.67. Now go back to the weekly. And in the weekly, what can we get for like $1 out of the money? Go to the 16 put and the 18 call and click on the bid, holding down control with both of them. Other side. The calls are on the left. The 18.
You said
the bid.
the bid?
Yep. So now we're looking at $2 and what is that? 46 cents.
Mm-hmm.
So when we go to the 11-day cycle, you see how it says 24 up top where it says 20. Stop. No, not up top. Up top on the option chain where it says October 24th. It's in yellow. It says 11 days, 100, all the way to the right hand side of that bar. You see what that says?
65%.
165% plus or minus what?
3.997. So 4.
So plus or minus $4. That's the expected move after earnings. That's what's being priced into those options. So effectively, we're buying an option that ideally would put us into a position where we make money if we get to the end of the week and these contracts that we sell for this week don't have value, then effectively we're getting long into next week's earning, or we're getting long premium into next week's earnings because those will fall off and they won't be there anymore. And we'll have reduced our cost to get into this straddle that we're buying by about $1.20. So go ahead and hit confirm and send. It should just cost you $250 or so. Yep. Bada bing, bada boom. So that's a cheap way to play earnings where we're basically betting for not a huge move up until the earnings, but then in the earnings week, it's going to leave us with long options where if we get a big move to either side, those contracts will make money if the move is more than 240 some bucks or $2.40. That's called a double diagonal is what we just put on. And it's a diagonal because we had different strikes on. So we chose, go back, now go to your position here and open it back up so we can look at it again on your monitor. No, on your monitor tab. So now you see how we have a weekly expiration and a monthly expiration.
Mm-hmm.
We have the 17th and the 24th. So this 17th is going to expire in 4 days. We collected $1.20 basically for selling that. The strikes are different from the ones that we bought on the 11th, right? For both cases. So we got long a straddle. A straddle is when you're buying or selling the put and the call on the same strike on the same expiration. That's a straddle. So what we've been doing up until now is selling strangles. A strangle is when you buy or you sell a put and a call out of the money on different strikes. So they're both away from the current price of the stock. This is right at the current price of the stock. So that's the difference between a strangle and a straddle. A straddle, you're literally sitting, just think of it like if you get on and you straddle a horse, you're on top of something. When you're straddling a stock, you're right on the strike price. When you strangle a stock, you're putting your arms around its neck. So you're going away from the center. And that's basically how they came up with these names to some degree. So we have a long what?
What?
So what's the name of the strategy for the expiration of October 24th for QuantumScape? Open it back up, QS. Those two long options on the 24th that expire on the 24th. What's the name of that strategy?
Didn't you call it like a
When you get on
strangle or
when you get on a no, just these two long options. On the 24th, where we bought both of them at the same, we're right at the price of the stock. We're sitting on top of the stock price.
a straddle?
A straddle. Think of it like you're getting up on a horse to straddle a horse. You're right on the stock price because they share the same strike. And then what's the name of the strategy for the one that expires in 4 days? Just those two that expire in 4 days.
A strangle?
Yes. So you've got a straddle further out in time, and you've got a strangle closer in time. When you combine those two, they turn into what's known as a double diagonal. And we'll get into diagonal spreads later on, but that one only has, so your overall risk in this, the most you can lose is that $250 that you paid for it. So it's a relatively cheap way to play earnings. Do you want to do another one, or do you want to be done for the day?
I think we'll be done for the day. That was a lot of information.
All right, so look at your overall delta in your portfolio here. The whole overall delta. Are you long or are you short overall?
Long. I thought long is where you're buying it, short where you're selling it.
Long does refer to buying something, and short does refer to selling something. But when it comes to your delta numeric value is giving you a direction of your risk in the market. So with your equities, what's your delta? Equities are stocks. So
20,
with
26.
26,
27.
long, is it positive or negative?
Positive.
So you're long 25 delta.
So positive is long and negative would be short.
When it comes to delta, yes.
Okay.
So you're long equities 25 delta. So basically, you're long the equivalent of 25 SPY shares, which is a $665 product. So 25 times 665. What's that?
25 times 605 or 55. I
Yeah.
do not know off the top of my head.
It's basically like 15 grand. You're long about 15 grand worth of stock, maybe a little bit more. Because right, 6 times 10 would be 6,000.
16,000.
Yeah. Okay. So you're long and somewhere between $15,000 and $20,000 worth of SPY right now with your delta from your equities, and then with your delta from your futures contracts, are you long or short?
Short.
How many delta?
36.7.
Okay. So are you overall long or short the market right now?
Short.
Right. And you're short by how much?
Like 10.
About 10 delta or 10 SPY delta, which means 10 shares of SPY. You're effectively leaning short the market, 10 shares of SPY. Do you understand how all that works together to give you an idea of where your portfolio is? So right now your portfolio risk is about $6,000 of short exposure to the market. Make sense?
Mm-hmm.
That's how you can, and that will also give you a gauge of knowing, all right, if the market's doing this, that, or the other, and I want to be longer or I want to be more short and I don't like my current exposure, that kind of gives you an idea of where to start and how to adjust from there. So if you need to pick up some long delta, that means you need to buy some things that have general correlation with the regular market. So like some equities that are going to give you that long delta, or even like getting short things like the VIX that have an inverse delta with the market. But it gives you a framework of where to start, and that should be something that you're monitoring every day, your overall delta within your portfolio, comparing it to what the market's doing and say, do I like my exposure? Now, we do need to add one other thing we need to add it to both your equity and your futures. Theta, 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 Theta. All right. So now, what's your theta?
176 and 145.
What does that mean?
I don't know, clue.
So your theta, so all these different things have different expirations. So open up some of your positions. They all have different expirations. They all have a bunch of different things all working. So open up a bunch of them. You'll see theta. Some of your theta is going to be positive. AMD is probably a good example. Open up AMD. You're going to see positive theta and negative theta in AMD. Right?
Yeah.
I don't think I have theta on mine. Hang on. I need to add it to mine so I can see as I'm talking to you. Theta. So what that means, that theta is time decay. So when you're selling an option, time decay is working in your favor. So positive theta, when you're selling options, positive theta is good, right? We want that positive theta. So your overall of 175 theta, that means every day you have $175 of time value that's coming out of your contracts. So you're making, if the market doesn't move at all, you make $175 today.
Okay.
That's working towards you. And you can see how, like with a position like AMD, when you go up to your AMD position, you see how your put has 7.22 theta positive, and then that short call that you have, I'm sorry, your put, I'm looking at the wrong thing, 17 theta, and your short call has 28 or whatever that is. But your long option, does that have positive or negative theta?
Negative.
Negative theta. Because when you buy a contract, you have a certain amount of time for that stock to make the move that you want, and time is always going to be working against you. The closer that you get to the end of that contract and the move hasn't happened for whatever strike you buy, the less value that contract's going to have. So that value is going to be decaying away. When you sell the contract, decaying value is great because you get to buy it back cheaper than you sold it for and you make money. When you buy it, that theta decay is working against you. So overall, right now in your portfolio, on a daily basis, you have 177 plus 145, or so over 300. You have about 320 theta, or $320 a day. That, now, granted, the stock never doesn't, or the market doesn't ever not move, but that gives you a gauge to measure based on not only your buying power in your account, your overall delta in your account, and your theta in your account. Those three combined, when you get used to monitoring them and you get used to like what's normal, how do they behave with stock movements, they will tell you something about your portfolio and your risk, because theta is also a good measure of risk. If you get to a point where this number keeps going up and up and up and up, and you have way too much theta on compared to even your delta or your buying power, then that is an indicator that you probably have a problem. Somewhere between 0.5% of your net lick, and net lick just means the money in your account that you have to work with. So I think your net lick right now is about 47,000 in this account. So your net lick, 0.5% of that would be around 250 or so, you're currently working somewhere between that 0.5% and 1% mark. So 1% would be 470 theta, and then 0.5% would be half of that, 235. So you're in between there, which is kind of a good spot to be. We'll go back and we'll touch on all that more, and we'll start to each day monitor our theta, our delta, and make sure that we start keeping them in line and making decisions about what kind of positions that we're going to put on.
Can't you see the candles rise and fall? Risk and reward, it's a game of all or no.
Thanks for watching. Don't forget to like, subscribe.
Options open, futures closed, eyes blind. Frustrated fathers dream in the stock grind. He's bleeding specs, faces blank as empty streets. Hedging positions, but the questions repeat. Time decay means nothing to the young souls. In this market play, it's like digging holes. Iron condor flies, but it never lands. They can't grasp the feel of these trade winds. Liquidity drive, choking on the sand. Profits and losses, they'd rather go play bands. Can't you see the candles rise and fall? Risk and reward, it's a game of all or no. Options open, futures closed, eyes blind. Frustrated fathers dream in the stock grind. Can't you see the candles rise and